I mean, the Fed just provides the liquidity, so it's hard to, run out of something that the Fed just provides in infinite supply. So the problem is inflation, and that problem is going to get worse. So it's not going to be a liquidity problem; it's going to be an inflation problem, and we're going to have an inflation problem because we have a solvency problem, which is we're insolvent. And so the only way to pay the bills is to inflate. And so we end up with inflation. I think it will be lower than it is now. I don't know exactly how much lower, but I think it will be lower than it is now. And I think inflation will be higher. And that means real rates will be much lower than they are now. I think it'll be above 3,000. I don't know how much further above it, but I think we'll get above 3,000 next year. I mean, it's going to break out eventually. I think 30 is a support. It could be $40 to $50, or it could be well above 50 if you can get above 50.
The Fed can provide unlimited liquidity, but the real issue is inflation, driven by the United States solvency problem. As the government inflates to cover its debts, inflation will worsen. While nominal rates may decrease, higher inflation will lead to much lower accurate rates. Gold is expected to surpass $3,000 next year, with strong support at $30 for silver, potentially rising to $40 to $50 or higher. PeterSchiff, a prominent American economist, financial commentator, and investment advisor, exposes that the US dollar remains strong despite massive money printing, deficits, and trade imbalances, because it is the world's reserve currency. Investors seek refuge in the dollar, even during trade war fears, despite the US being the most vulnerable as a major importer. While the dollar could collapse unexpectedly, policymakers could also intentionally devalue it through interventions or increased money printing. However, a weaker dollar might drive inflation and higher interest rates, complicating economic recovery and trade rebalancing. Historically, private banks issued gold-backed currencies without federal involvement, and the monetary system worked well. The original Federal Reserve Act required Federal Reserve notes to be 40% backed by gold and 100% by commercial paper, banning the Fed from holding U.S. government debt. Its purpose was to provide an elastic money supply, expanding during growth and contracting during recessions. Today, the Fed only expands the money supply, regardless of economic conditions. Returning to the Fed's original purpose or eliminating it would be better than allowing the government to take over, which could be even more disastrous. Peter highlights that the U.S. national debt is growing rapidly, currently at $1.1 to $1.2 trillion, and expected to reach $2 trillion by the end of next year. With $3 trillion added annually, borrowing at 4% interest adds $120 billion in interest costs. Additionally, as older debt financed under 1% matures and is refinanced at over 4%, interest expenses could increase by hundreds of billions more. As you watch the video clips, please take a moment to like, subscribe, and hit the notification bell to stay updated with our latest uploads. We appreciate your support. Enjoy the video.
Everything we're doing should have already devalued the dollar. All the money printing and the deficit spending, the trade deficits, the budget deficits. If we were a normal country, the dollar would be much lower than it is today, but we're not, because we have the reserve currency and everybody just takes refuge in our currency. Like now people are worried about a trade war, and so they're buying dollars, even though the U.S. would be the biggest loser of any trade war. So we are the country that is most dependent on imports. And if we make imports a lot more expensive, it's going to be the most harmful to us. But again, people don't seem to understand that. And so they're buying the dollar anyway. So the dollar could collapse at any time, completely without the control of Trump. But obviously, if Trump wanted to orchestrate a dollar decline, I mean, they could do that. I mean, they could come out and specifically state that they wanted a lower dollar, and they would probably get one. They could encourage countries to intervene and sell dollars, although that might be counterproductive, because if the world is selling dollars, they're also selling their treasuries, driving up interest rates. But then again, the Fed could print more money and buy those bonds and create more inflation to devalue the dollar. I mean, it's not good for America to have a weaker dollar. But as long as the dollar is as overpriced as it is, I think it's going to be very difficult for us to turn around. Before we had a Fed, we had private banks that issued their own currency, and it was all backed by gold, and everything was fine. And the federal government had no role in the monetary system whatsoever, and there was no central bank. So that'd be fine with me. I would also be in favor of restoring the original intent of the Fed. The original Federal Reserve Act, the way it was initially proposed, ratified, and signed into law. If we still had that Fed, I'd be okay, right? Because the way the Fed was conceived, Federal Reserve notes were going to be 40% backed by gold, 100% backed by commercial paper, which was liabilities of other banks. And the Federal Reserve was banned from owning any obligations of the United States government. So not only couldn't they buy any U.S. treasuries from the government, they couldn't go into the marketplace, the secondary market, the way they do now, and buy treasuries. So the Fed couldn't have any U.S. debt, any mortgage-backed securities. None of that could be part of the Fed's balance sheet. And if you look at the original purpose of the Fed, which was to provide an elastic money supply, what that meant is when the economy was growing, the Fed would allow the money supply to grow. But when the economy was contracting, like in a recession, the Fed would shrink the money supply back down. That is the opposite of what it does today. Today, when the economy is doing well, they expand the money supply. And when it goes into recession, they expand it even faster. So there's nothing elastic about that. It doesn't expand and contract. It only expands at various speeds. So we got to go back to the original purpose of the Federal Reserve, or we got to get rid of it entirely. But what we can't do is let the U.S. government assume the role, because that would be an even bigger disaster. Probably get there but I think by the end of next year, we'll be at $2 trillion. I mean, we're already at about 1.1 to 1.2 trillion right now. And it's going up. If you look at the fact that we're adding about 3 trillion a year to the national debt, and if we have to borrow that 3 trillion at 4%, that's just an extra 120 billion in interest that gets added just on that. But over the course of the next year, maybe a third of the national debt matures, and a lot of that debt is financed at well under 1% interest rate. So let's say $10 trillion matures and has to be refinanced at an extra 300 basis points. That's another 300 billion in interest there. So it's really growing at a rapid pace.
Peter says that a weaker dollar and a major recession may be necessary to make the U.S. competitive in manufacturing. However, Trump and Capitol Hill are reluctant to embrace this due to promises of immediate economic growth. Instead, inflating the financial bubble further, as past administrations have done, is the likely short-term solution. Actual progress would require a leader willing to endure the short-term pain of addressing the bubble, but no one wants to face the blame. In a recent interview, Peter exposes that the Fed has been monetizing debt for years, with a $7 trillion balance sheet from quantitative easing and more to come. Heavy reliance on the dollar's reserve status and enormous debts, including $36 trillion in national debt and hundreds of trillions in unfunded liabilities, the U.S. economy faces a grim future. Massive money printing is inevitable, causing the dollar's value to plummet further. Since the Fed's creation, the dollar has lost over 99% of its purchasing power. Moreover, gold has had a strong year, reaching record highs in currencies like the Canadian and Australian dollars, the euro, and the pound. Despite trimming gains in USD since Trump's election, the dollar's strength stems from false optimism about the U.S. economy under Trump. Without this illusion, gold could be $200 to $300 higher. As reality sets in, gold prices will rise, and gold and the S&P 500 will eventually decouple. Now let's dive into the interview.
He talks about a strong dollar, but to really make America competitive again in manufacturing from where we are now, it's going to require a weaker dollar, I think. And it's going to require a big recession, which nobody seems to want to embrace up there on Capitol Hill, because Trump promised an immediate economic boom, which can't be delivered. All that we can deliver is more air in the bubble. So if Trump just wants everybody to feel better immediately, the only way to do that is to inflate a bigger bubble than the one he inherited from Biden. And it's not like he just inherited it because he turned it over to Biden. He inherited the bubble from Obama and allowed it to get bigger while he was president. And so we've been passing this bubble from president to president. What we need is a president who's going to prick it. But nobody wants to, because they don't want to get blamed for the short-term pain that doing that would bring about. The Fed has been monetizing the debt for years. That's what quantitative easing was all about. That's why the Fed has near $7 trillion balance sheet. That's $7 trillion of debt that's been monetized. Now they're going to monetize a lot more. I think they're just getting started. I don't think it's going to be exactly like Japan. I actually think it's going to be a lot worse. I think that beneath the surface, the Japanese economy was actually in better shape than ours. Yet their central bank made a lot of mistakes to create a situation that's much worse than it needed to be. And our central banks have made the same mistakes. But, we've been able to get away with it. And the question is for how much longer? But I think that at the end of the day, we're much more vulnerable with the enormity of the debt, not just the $7 trillion or $36 trillion national debt, but the couple of $100 trillion of unfunded liabilities, Social Security, Medicare, government pensions, guaranteed mortgages, guaranteed student loans. I mean, there's so much of debt out there that the U.S. government has got the U.S. taxpayer on the hook for. Of course, the taxpayer doesn't have the resources to make good on the debt. So it's just the Fed that prints the money, but it's trillions and trillions and trillions of money printing that's baked into the cake, and so the dollar has to go way down. I mean, this is just the beginning. You look at gold at $2,600. When the Fed was created, you could buy an ounce of gold for $20. So what does that tell you? I mean, the dollar has lost better than 99% of its purchasing power since the Fed came on the scene. Whereas before the Fed came on the scene, in 1789. You needed $20 to buy an ounce of gold. And in 1913, you could still buy the same ounce of gold for $20. So before the Fed, we had a stable dollar. Ever since the Fed, we've had a collapsing dollar. And I think the speed of the collapse is accelerating and will accelerate from here. Well, it's been a good year for gold. Gold has pared its gains a bit in dollars since Trump was elected, although it's gone on to make new record highs in other currencies. The Canadian dollar, the Australian dollar, the euro, the pound. We've seen record high gold prices after Trump was elected. And that's because, the dollar has benefited from a lot of the false optimism surrounding the U.S. economy and how it's going to fare relative to the rest of the world based on Trump. And I think if the world didn't have so much false optimism, I think the gold price would be, quite a bit higher than it is now. Probably, maybe $200-300 an ounce higher than it is. I think we're going to get there. I think it's just going to take a little while for the illusion to fade and for people to wake up to the reality of the problem.
The U.S. economy faces mounting challenges from inflation, unsustainable debt, and over-reliance on the dollar's reserve status. While gold and silver present opportunities for wealth preservation amidst these issues, addressing the root causes, such as monetary policy mismanagement and structural economic imbalances, requires bold leadership and systemic reform. Without meaningful action, the trajectory of rising inflation and a weakening dollar seems inevitable. How can policymakers balance short-term economic stability with the need for long-term structural reforms? What role should gold and other hard assets play in safeguarding wealth during economic uncertainty? Let us know in the comments below. For more content like this, don't forget to subscribe to our channel, hit the notification bell, and explore our other videos. Thanks for tuning in.